All right. Today is Sunday, the 27th of October. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. You know what's really interesting about this week in the stock market? It was absolutely frustrating. All in all, we closed pretty much flattish for the week. But day to day, it was absolutely frustrating. If you bet one way, they slapped a pie in your face the very next day. In the first video of the week, I said a big trap is imminent, but for who? Now, if you assumed based on the action Monday, Tuesday, that the market is heading higher, they flushed you down Wednesday. So that was a bull trap right away. Now, if you assumed based on Wednesday's action that we're going to head down, they flushed you out of the trade by Friday since they moved the market higher. And that was the bear trap. Now, if you looked at the action on Friday morning, and you said, you know what, the market is heading higher, the NASDAQ traded at the highs, and the S&P did this and that, and you bought some calls or you bought some new positions, they flushed you down by the end of the day. So it was a trap within a trap within a trap. But it's not the big one. The big one comes this week because it is the most critical week for the year so far. It's the most important week for the stock market this year because we have big cap technology earnings. We're GMAF. We had two of these before. What makes this report, this quarter, more important than the last two? The answer simply is we're going to run into bigger numbers. And the possibility of peak margin expansion by the big cap technology companies is real. And since the shock that we got in the summer, in the month of August, you can see that the Qs, the NASDAQ, did not really recover. The big caps did not really recover the highs. The semiconductor names did not recover the highs. It was the initial shock. This week could be the confirmation of the initial shock. And if that is the case, then forget about it. The indices are heading down from this point all the way to the end of the year, maybe beyond. Because we are all aware about the weight problem that we've been talking about for months now. That the market is concentrated in a handful of names. You live by the sword, you die by the sword. We've seen what happened to the stock market indices when these names experience a bubble. The markets rocketed higher even though the breadth was really bad. It was just the handful of names participating. What we haven't seen yet is the die by the sword part. What happens when we hit peak margins? And now these companies begin to worry about costs and reducing spending and more margin management. Not to mention, of course, the weakness in the economy that will begin to impact revenue. This is, of course, what makes this week incredibly important. And again, the most important week of the year. Now, if these companies provide really good earnings and we see margin expansion still going higher, really hard to see because the numbers from last year were high and they keep getting bigger. So mathematically it becomes impossible to continue to expand margins. But if they show it, then you'll see a different reaction in the market. You'll see a lot of folks chasing for the year-end performance. And again, that's the big trap. There are the folks who are now positioning for the year-end rally and chasing all of that. If the big caps come out with peak margins, forget about it. We're going to have a big flush down. If folks are betting on peak margins, we're going to flush down, but we see the big caps delivering, then we will see the market rocketing higher. So the big trap is not delivered yet. But the intraday activities this week provided a lot of mini traps for both sides. Now, an important question since we're talking about traps. Was Friday's close a topping candle? That's what a lot of folks are talking about right now. If you look at the Qs, the NASDAQ, if you grab any technical analysis book, it will show you that this is a topping candle. We've seen a gap higher, trading at the highs of the day, then closing at the lows of the day, aka the possibility of a reversal coming. You look at the SPX, the S&P 500, and the highs were already a few days before, and it also looks like we closed at the lows of the day. Not the classic topping candle, but the possibility for peaking in the S&P 500. You look at the Dow Jones. It already peaked and it's moving down at this point. So the question now becomes, was it a topping candle? And is this it for the market? Let's discuss the case for, yes, it is a top, and the case for, no, it's not a top. We begin with, yes, it is a top. And the first thing that comes to mind is the VIX. You folks noticed what happened this week in the market. It appeared as maybe the market wants to go higher. You saw NVDA going higher, a lot of names trying to go higher. But that VIX keeps coming back. Something is making the market afraid. And it goes hand in hand with gold and the dollar moving higher. But the VIX is known as the fear or the volatility index. And it closed above 20 at the end of the week. And it closed at the highs of the week. If we trade above 20, We identified this as a bearish confirmation, and it was third time as a charm. If you look at the 4 hours chart, we tried once, twice. Friday was the third time, and it was a success. And usually when you see these kind of breakouts, they last. They're not a false breakout. Then you look at the monthly chart of the VIX, and we have bullish momentum going on, meaning that we're probably going to see increasing volatility. And specifically as we head to the last week before the elections, you combine that with the candles that we got in the market indices on Friday, and you can make a case that yes, volatility going higher for a reason. And with that, we see that any attempt for a rally being pulled back. And so long as the VIX keeps going higher and we see hedging, the indices will head down, and thus the candle from Friday was indeed a topping candle. The other point is the dollar and gold. Both of them been rallying together, and that's usually a bad sign. It doesn't last for too long because these two are enemies. If the dollar goes higher, gold goes down. Dollar goes down, gold goes higher. But when you see both of them going higher, as we've been witnessing this week and the week before, there's an underlying message of fear. It ties in with the VIX. There's something that's making the market afraid. Is it the geopolitics? Is it the elections? Is it big cap earnings? Something is making the market afraid. And we've seen this phenomenon before. Usually, once again, gold and the dollar, they trade against each other. Yeah, you're looking at right now gold in orange, and then you got the dollar in green. You can see that they've been trading higher together in the last couple of weeks. When did we see that last? You have to go back to 2008, 2009, before and during the crash of the stock market. We've seen the dollar and gold heading higher together. The bottom line is, if you want to argue that we've seen signs of a top and a move down from this point on in the stock market, all you have to do is just look at the behavior of the VIX, the dollar, gold, and the next point is bond yields. The Federal Reserve cut rates by 50 basis points. Yet bond yields rocketed higher. What you're looking at right now is the 30-year bond yield weekly chart. You got to remember, before the initial shock that happened in August, and I think once again, I'm going to keep repeating this, we're going to look back at August as a really important and significant event in stock market history because it was the early warning sign for what's about to come. That there is a mechanical problem with the market. And you've seen what happened in the way up. You haven't seen what happens in the way down. When the algos gets one recipe and they just go with it full blast. But the flush down in August gave you a little taste of that upcoming event. But we go back to this chart of the 30-year bond yield. You got to remember that before the August shock, the market was not pricing any rate cuts. The market was pricing in that in September, the Federal Reserve will keep rates as it is. Once we got the shock in August, that's the point when we began pricing in 25 basis points, then 50 basis points. But right now, the 30-year bond yield, which by the way impacts mortgages, credit card, all kind of stuff in the economy, the rate is higher than it was prior to the month of August, before the initial shock. What is the message here from the bond market? It says that the Fed made a mistake, and we're probably going to see tighter policy, not looser policy, in the near future. What is the reason behind that? Inflation fears? Election fears? Who knows? But the message by the bond market is, we got a price. If you thought that there was easing coming, that's why the market went higher, in buying the dip in August all the way till October, you got to price all of that out. So looking at the bond market, it solidifies the idea that what we got on Friday is indeed a topping candle. Now, the other case for it is the rotation lag. So we know that the big caps, the chips lagged since the summer. But the idea was, hey, we have a rotation. Other things are playing out. The market began to open up. It was a certainly more interesting market than it was, at least for a year and a half. We're talking about the period from July all the way till what we have right now. Certainly more active, a picker's environment, which was more interesting, at least to me. But the problem is, this week and the week before, we've seen that the rotation also stalled and lagged. What you're looking at right now is the SPX. You can see that if you go back about 2 weeks ago, the S&P is flat. But then you look at the rotational elements, such as the IWM small caps, that's down. The IYT transportation, that's down. You look at the XLI industrials in orange, that's also down about a little over 1.5%. So the rotation lagged. The big caps still stalling. NVDA is the only one that moved higher. Meaning, if the big caps go down this week, can the rotational elements cover for a disappointment by the big caps and a move down by them? The answer is highly unlikely because they're underperforming as we speak right now in the last 2 weeks. Then you look at the IWM, the weekly chart, and it looks as a bearish engulfing candle. It took the entirety of the body of last week And you look at the momentum indicators. I mean, you look at the RSI kind of stalling, the MACD stalling, perhaps a reversal from bullish to bearish is coming near. You see the vortex indicator. The red line is firming up. That's your bearish indicator. The blue line, your bullish, is trending down. And the Russell 2000, the IWM, is the poster boy for the rotation. So if you take the big caps out and the rotation out, then it was probably a topping signal that we got on Friday. And here's the last argument, since we've been talking about it, big cap earnings. These are the names that made the market. 23, 24. I should say rescued the market from a horrific outcome as we were heading from 22. You got to remember, we got hit with a banking crisis, and that should have taken the market down big. The only thing that kept the market going, it ain't the Fed rescuing the banks and all of that. Sure, that has an impact, but we've done that before, and more banks failed, and more banks will fail. What carried the market is the AI bubble. The B2B spending between these giants kept the market afloat. With keeping the market afloat, the wealth impact in the economy kept consumer spending intact, at least for a certain class of consumers. We know the poor and even the lower middle class getting annihilated, and soon enough, the middle class. Debt's rising. You know the deal. We talked about this in details before. What happens if the big caps peak and come down? You diminish the wealth impact. It ain't just the top in the market, but the beginning of the recession in the economy officially, which again, when we look back at it, recession began about a year ago. But you got to remember, I showed you the videos before. Back in 2009, when the crash already happened, the economy was already in a recession. They said, the economists actually did a study, and they concluded that the recession began in December 2007. They'll say the same thing this time around. We've done a study, and the recession actually began when the banking crisis hit in March 2023. That's when the poorer consumer began to get hit really hard. In any case, since we're talking about the market and big caps right now, the problem with the big cap earnings, the bar is way, way too high. It ain't just the law of large numbers and beating the margins year on year. You look at the forward PE ratios for some of these names. I mean, the entirety of the market is absurd right now. But it's even more absurd in some of these technology names. You got Microsoft at about 28 times forward PE. Apple, 31 times plus. Google, 19. The most reasonable, but we know for a reason. Meta about 23.5. Amazon, 32. NVDA, 35. You look at the Ozempic mania, Eli Lilly, 40. And don't discount the weight of Eli Lilly on the NASDAQ. You look at Tesla, 82.5. Now, Tesla managed to give an upside surprise because they've improved margins. And there was a lot of shorting beforehand, so we've seen a mechanical squeeze. Can these names, the Amazons, the Metas, the Googles, the Apples, the Microsoft, show us an improvement in margins? They've already exhausted the tool that Tesla utilized, which is getting rid of employees. These big cap companies already did that back in 22. Now, the only way you can improve margins, either cutting spending on AI, which will be disastrous, or increase your revenue. But we know that increasing the revenue is becoming more and more challenging as the cyclical economy begins to get weaker. The consumer gets weaker. And if we see margins peaking, not looking pretty good in these names, the reaction by investors will be dropping these stocks down as to send a message to management. Hey, you gotta manage some of the margins problem that we got. And these companies are going to respond by cutting some spending. That's going to be bad for the AI mania, probably going to pop the bubble if it wasn't already popped, because we talked about the export controls and all of that. But this will be the official pop. But then what happens in the future? If we get peak margins and we see a disappointment and the management is now called to cut cost and cut spending to recover the equity price and please investors again, can they have the ability to cut costs and spending at this point when you are amidst an AI war with other giant companies? They have a limit. Their ability to reduce costs and improve margins is going to become really, really limited. And that's going to impact the performance of these stocks dramatically. And again, if these stocks go down because we've got peak margins, and they cannot really improve it much because they have to continue to spend, maybe reduce a little bit, but continue to spend because they're amidst an AI war. And these stocks will become the underperformers. And if they become the underperformers, it doesn't matter if you have utilities going higher or energy or banks or whatever. They're going to take the indices down with them. So that's the case for, yes, we got a topping signal Friday. What is the case against, though? Number one, what if it was just options expiration? It wasn't the monthly expiration, but it was a weekly expiration. We've seen a lot of calls being bought, chasing NVIDIA and chasing Apple and all of that. What if the market maker just wanted to flush some of these calls out of the picture? And they did the roller coaster ride that they've done on Friday. That's a possibility. The other case, and perhaps the strongest case for no, it was not a topping signal, comes from the Middle East. So we've been waiting on pins and needles. This Israeli response to Iran. And they hyped it up. Oh, it's going to be something you've never seen before, devastating, lethal, yada, yada, yada. And then the actual response comes out lame. There is damage. The headline reads, satellite photos show Israel hit Iran former nuclear weapons test building, missile facilities. They hit a lot of the defense equipment, aerial defense equipment. There are casualties in the Iranian military. So it's not a nothing burger response, but it is certainly way, way, way weaker than what we've anticipated. As a matter of fact, the Iranians laid down the Israeli strikes, saying that they caused limited damage. What is the point here? The point is, we're not going to retaliate to this retaliation. And once again, folks, I think that the Israeli strike was supposed to be bigger. But I think that U.S. and Russian intelligence helped Iran thwart at least 70 to 80% of the attack. Why did we help Iran? Because we don't want to start a war and a retaliation before the elections. So we kind of sent a warning to Israel already by the leak, wink, wink, that happened about a week ago. And then, of course, leaked some information to Iran that, hey, they might hit some stuff that causes civilian casualties. Here's how you can protect yourself from these kind of things. We didn't tell them everything. That's why the Israelis were able to hit some things. And of course, Russian intelligence probably provided a lot of information to the Iranians. And the majority of the attack was thwarted with limited damage, but also you cannot minimize the degree of the damage because there could be a catch and a big, big twist in all of this. More on that in a second, but let's go back to the market here. Why is the Middle East important? Things leak ahead of time, folks. That's the name of the game in the market. That's why certain folks become rich by insider trading the market. You don't get rich in this country by working hard and following the rules, all of that bullshit. They just tell you that so you can stay obedient and work your ass off till you die, making the corporations richer. And then you're lucky if you have some shitty home where you can house your family in. Anyways, you know what I'm talking about. You become rich in this country by trading the market and using insider information. And that leaks all the time. What if the leak was, hey, the Israeli response will happen tonight? That was Friday. And the traders bought the VIX, bought hedges. And of course, when you buy hedges, the VIX goes higher. The algorithms dump the market. What if the candles that we see in the charts were just a product of this kind of dynamic? Where folks thought that it's going to be a big and a huge response. It's going to happen tonight, got the confirmation. So they hedged and they bought the VIX and all of that. And the algorithms, the robots, dropped the market down. But now, as we open Monday, knowing that the response was lame and tame, you see the market trading higher again, VIX going down, and oil going down certainly. Overnight, oil is down 4%. We'll talk about oil in details in the commodities coverage in a minute, but it ties in together. If oil is down, then shouldn't the VIX be down? Shouldn't equities go higher? And this was all about leaked information and folks using the information to bet on a big attack, which did not happen. And now we have to unwind all of these bets. That's the case for no, it's not a topping signal, what we got on Friday. Now, I know this is the market coverage, but let's talk a little bit of the geopolitical situation here, because a lot of folks, I think there's a trap here. It ain't just in the market. I think there's a trap in our assumptions of this Israeli retaliation on Iran. I think the Israelis were preparing for a massive response, a shock and awe kind of response. But we talked them out of it. And then we leaked the information ahead of time just to say, hey, be careful, don't do it. We have an election coming. But the Israelis want to send something, a message. And they decided that, look, we'll do something insignificant right now, but that something is going to hit the aerial defense system in Iran, near nuclear facilities, near oil facilities, near military facilities. And then after the elections, you will see the real Israeli response, which will be hitting the nuclear facilities and hitting the oil facilities and the military facilities. Now, why would Israel do this? If they hit Iran hard before the elections, they're putting all of their eggs in one basket that Trump is going to win the elections. And right now, he's leading in the polls. But what if Kamala wins at the end of the day? It's going to backfire in a big way against them. So this is their way to say, we're going to play it both sides. If Trump wins, if Kamala wins, but after the elections, all bets are off. We're going to force, this is Israel saying, of course, we're going to force whatever American administration, that is Trump or Kamala, into a situation that immediately after the elections, we're going to hit big. You're going to see the real Israeli response. I mean, why would you hit the defense systems around the nuclear facilities and the oil facilities and call it a day? I think they're preparing for a next attack, the next response. So keep that in mind, that the assumptions that we have right now is one thing, but there could be a massive, massive cramp here. But anyways, let's go back to the discussion that we got. What is the other case for no, it was not a topping signal on Friday? Well, you got NVIDIA. You can't really drop the market down without dropping NVIDIA down. Biggest name in the stock market right now. If you look back since the beginning of the month of October, NVIDIA up 20%, the market is up about 2%. Now, the majority of the market is down. So the only thing that kept the indices afloat positive for the month of October is the outperformance by NVIDIA. If NVIDIA goes down, then it takes the indices down. But for now, if you want to argue that Friday was a topping signal, then we're not seeing it in NVIDIA yet. And thus, we cannot assume that it's a topping signal for the market either. The other case for no, it was not a topping signal. The monthly charts. When you look at the monthly chart of the SPX, not yet. The month is still young. We got another week going. But for now, the way that we have it right now, there's no topping candle yet. You look at the NDX NASDAQ monthly chart, no topping candle yet. Maybe the top was in August or July rather. And we're going to fail at this point, then head down and we're going to look at that, semi-doji. It's not really a doji, but it's sort of an indecision candle in July. As, okay, that was the top. Now down we go. Still too early though. There's nothing in the monthly chart that says, hey, Friday was a topping signal, if you want to argue that way. Now, I have to warn you though about that candle. It looks red here. But let's go back in time. .com bubble. Here's the NDX. If you think what we got here is impressive, you haven't seen anything yet. Go back to the .com bubble. That was impressive. That was insanity on steroids. And now we have the insanity that we have right now is more dangerous. It's not as impressive, but more dangerous because it involves the biggest names in the world. But then you look at the NASDAQ in the .com bubble. It ratted all the way till we've seen this similar looking candle. It was green in 2000, not red as we see in July 2024. Now scroll a little bit and move the chart. What happened after? Got the confirmation for a top in the monthly chart. Now boom, that was the end of the bubble. And erased the entirety of the insanity of this rally. All of it gone. When folks say, oh, yeah, if we crash from this point on, we're just going to go down 10 to 20%. No. He'll take it all, okay? Because once we see the peak margins, market begins to go down. That's going to impact the wealth effect in the economy, which means that the economy is going to slip into an official recession now. And you know what happens in these scenarios? This market is dangerous because of this mechanical loophole, this mechanical problem in the market as I see it. There's an error in the way the algorithms are trading the market. They overreacted to the upside. We all seen what that looks like. You haven't seen how they're going to react to the downside. Overreact, I should say. And that could actually exacerbate any upcoming downturn. Anyhow, the last point for no, Friday was not a topping pattern. What about the positive earnings that we've gotten so far? Wouldn't these lead to the big caps that they're going to be okay too? When you think about Tesla, the revenues are flat. That company already peaked when it comes to revenue. It's an automobile manufacturer. And it's going to run into the same problems. Peak margins, peak markets, and then either going to raise the prices higher or sell more cars. Otherwise, your revenue is going to stay the same, if not head down. And Tesla understands that. So the remedy for now was let's cut costs and increase the profit. And they fired thousands and thousands of employees. How many more employees can you fire before you run out of that tool? But for now, wasn't that a positive report that defied the expectations? Yes, it was. What about UPS? UPS is a good leading indicator for the economy. And this report, we've seen a rebound in margins, rebound in revenue, rebound in business. Wouldn't that also lead that we might see more business for advertising and Meta and Google and all of that? But we see the big caps actually performing. And if that is the assumption, then no, it was not a topping pattern. Well, we got on Friday. So anyways, now that we've discussed the case for and the case against, what about the hierarchy of the week? I think this week earnings, without a doubt, will be the number one most important element. Live by the sword, die by the sword, and Microsoft will be the most important earnings ever. And the reason is, it's the sugar daddy of this AI mania. If they cut down spending because they have a margin problem, you're not going to see it in this report, but if they have a margin peak, they're going to have to begin to trim spending. That's going to be the assumption by the market. And then it's going to impact all of this sphere of the AI mania, from NVIDIA to the smaller chip names, to the other big caps, to the utility companies, to the power companies. All of them will react negatively if the sugar daddy begins to stop spending. Or shall we say, they're never going to stop spending, but they're going to reduce spending or have better management when it comes to spending. And that means less money for all of these companies that have been enjoying the billions and billions of dollars by Microsoft. Number two, the elections. This is the last week. November 5th, we have the elections. So this is going to be the last week of trading before we get the elections. And of course, usually what we see Folks begin to hedge, the VIX goes higher, market goes down, and then after the results come out, and there's nothing bad, no civil war, no chaos or contested elections or a super majority by one party, we see the market recovering higher again. Because the market in reality doesn't give a shit about who's the president gonna be. Both parties will serve the oligarchy. But this is not a usual election, and we might see chaos after the results are out. So of course, you're gonna see hedging before the elections are out. Number 3, the Fed policy. And we have 2 important macro data this week. The jobs report, that comes out Friday. But before that, on Thursday, we have the PCE. The jobs report, of course, is way more important than the PCE, which is a lagging indicator. The jobs will be important because this is the last one before the elections. It ain't going to impact the voting. The voting is already here. So will we see the reality of the jobs market? Now that the temporary jobs for September, the government jobs, are not going to be full-time anymore, will we see the reality? And would that impact the outlook for the market, as to say, wait a minute, the recession risk is now coming back in. And look, the market doesn't fear the inflation risk right now as much as it fears the comeback of the recession risk. Keep that in mind. And that leads us to number 4, technicals. If we have a bad jobs report, what do you think that's going to do to the dollar and bond yields? They're going to flush down big because they've been rallying relentlessly, day after day after day. If you introduce any recession news, they will flush down big. And that's going to open really important trades. So we gave you the guideline here. Folks love to talk about the market, quote unquote. And I explain to you, I talk to my Discord members all the time. There is no such thing as the market right now. If you're trading the SPX and the Qs or the SPY, you're trading the big cap technology stocks in NVDA. That's what you're doing, really. You look at these charts, they all look similar. And all of these assets, the indices, they're impacted by the indicator, which is the VIX. If we see hedging, VIX goes higher. The algorithms take a signal and they sell the indices. And by selling the indices, they dump the big caps. So if that's what you're talking about the market, then it's the VIX big cap phenomenon. But there are 2 other markets, the dollar-sensitive side and the yield-sensitive side. The dollar-sensitive commodities, metals, gold, silver, oil, chemicals, fertilizers, emerging markets, solar, a lot of things. And if we see bad jobs report, dollar flushes down, these guys are going to go higher. You have the yield-sensitive side. The dividend, the defensive, the small caps, regional banks, home builders. Of course, they're divided in 2 categories. The risk-on categories, the risk-off categories. Risk-on, the poster boy is small caps, profitless companies, home builders. And risk-off, poster boy is the dividend, defensive, real estate kind of ETFs. But at the end of the day, if we get recession news, because this is really important, if we get recession news from the jobs report and we see yields going down, it's going to be good for this category, but not all of them. It's going to be good for the risk off, the dividend, defensive, those kind of stocks. And you might see actually the indices going down big because, Apple blew up or Microsoft blew up or Meta, whatever. But then you see these names, the other categories in the dollar and yield sensitive side going higher. Keep that in mind. And the last event in the hierarchy of events is the geopolitics. Now that we know what the response is, and we know that if there is, as my theory, that the Israelis will give us the real response, but that's going to happen after the elections. The Iranians are going to have their guard down. Okay, they did the hit and it wasn't that significant. Let's just relax now. Then the Israelis hit after the elections. For this week, the geopolitics goes all the way back to number 5. Anyhow, folks, let's add more color to this conversation by revisiting the market activities this week, beginning with the closing of the indices on Friday. And here we go. The diamonds closing in the red, down by 259.96 points or a loss of 0.61%. The Nasdaq, the only positive index for the day, up 103.12 points or a gain of 0.56%. The Spider down beat flat by 1.74 points or a loss of 0.03%. And the Russell 2000 in the red, down by 0.83 points or a loss of 0.38%. So you can see that initially, the SPY, the Nasdaq, even the Dow, and the Russell, all of them, traded higher. Then we've seen that flush. And we just debated, was that a topping signal or not? Looking at the sectors, number 1, comm services. Thank you to Meta and Google. And then you have technology at number 3. Thank you to the NVIDIAs, Amazon, the big caps, all made a comeback on Friday, be it a tiny comeback, since we've seen a reversal of that by the end of the day. And of course, consumer cyclicals at number 3. Thank you to Tesla. With the squeeze right now, it's a mechanical phenomenon. And we're going to have a really good discussion about it, folks. I do have the notes right here. That's the paper right here. The script is right here. The information is already here. I just couldn't squeeze the segment in this video. It's going to make it too long and too late. So we'll do the Tesla video separately. And stick around till the end of the video because I have a really important message for you about the programming this week. I'll tell you what we're going to do Monday and the bonus videos that we're going to do. But anyways, back to these sectors. The laggards, utilities, financials, real estate, defensives, healthcare, they're buckling under the weight of yields continuing to go higher. But all in all, with utilities, real estate, defensives being the laggards of the day and the winners, comm services, technology, it was a risk-on kind of day, despite the midday reversal and the VIX going higher. Here's the problem, though. You look at the weekly sectors' performances, pretty much all of them in the red, and even cyclicals, thank you to Tesla, just a touch positive. Comm services, just a touch positive. Technology was actually negative all in all, despite NVIDIA's outperformance this week. Then you see the rest of the market getting hit pretty hard. A lot of that is related to earnings. So if we look at the breadth on Friday, it wasn't really that good. The NYSE 33% advancing versus 66% declining. The NASDAQ, even though closing positive, the breadth was negative. 44% advancing versus 53% declining. Looking at the heat map on Friday, since we talked about the breadth being bad, that means the outperformance is coming from a handful of names. And those are the big caps, the chip mania, those are the ones that traded higher. Of course, Tesla with the squeeze, but the rest of the market went down. And you see significant losses even in the financials now beginning to respond to higher yields. You see that real estate, utilities, defensives, all now responding to higher yields. Healthcare is responding to earnings, de-risking a little bit before earnings come out for the major names, which some of them will come out this week. Then you have McDonald's down another 3%. McDonald's has a unique circumstance with the E. coli, the food poisoning thing with the quarter pounders. You eat a quarter pounder, next thing you know, you're pushing a 10-pound shit, which could be fatal, by the way. I'm just waiting for those AI toilets. Anyways, energy was positive on Friday, but we know why. Folks were betting on an Israeli strike. On Friday, the news leaked, and of course, there was some bid in oil. But we contrast the picture with the week. You can see a lot of names went down, even in technology, the software stuff, and the cybersecurity, and the big caps. Apple was the laggard. Even in the chips cohort, you see AVGO down, ARM down over 6%, Micron down about 3%, but then NVIDIA up about 2.5%. And right now, a lot of this could be earnings bets that folks are betting on Microsoft and NVIDIA, but if these earnings come out bad, then what happens when these guys go down and now we don't have the counterbalance? When you have ARM, AVGO, Apple, Google, Meta, Amazon going down, the counter was Microsoft and NVIDIA going higher. What if these two begin to go down? It ain't going to be a good picture for the market. The true outperformers for the market this week came from Tesla. Again, that's a short/gamma squeeze. We'll talk about Tesla in details again in a separate video because the revenue was flattish. So we'll do the case for and against in details. But the other true winner for the week was Philip Morris, up over 8%. We talked about Philip Morris positively months and months before. That as we hit the late stage of the economy, dividend-paying name with pricing power because it is a habit that you're not going to kick out easily. You're going to pay the higher price. And as the economy gets weaker, more and more folks are smoking. So Philip Morris was an outperformer for real. It wasn't because of options or any of these games. But besides that, it was pretty much an earnings kind of response. Besides Philip Morris, you had ServiceNow and Lam Research. Those were positives. And of course, as we said, McDonald's had its own circumstances. Other names like Coke and Verizon and GE and Lockheed Martin and some names in the financial sector went down because of their own earnings reports. Yet the indices held flattish. Why? Because you got Microsoft and NVIDIA. So this is why this week is the most important week for the year. If these guys begin to go down, doesn't matter what the rest of the market does. The indices will go down too. Looking at the heat map for the week for the ETFs, the TLT was down, meaning that yields went higher and wasn't just a tick higher. It was much, much higher. TLT was down about 2%. Right off the gate, you see the risk on, the risk off, yield sensitive did not do pretty good. Risk on IWM down about 3%. KRE down about 3%. XBI Biotech down a little over 2.5%. XRT Retail down a little over 3%. ITB, XHB Home Builders and Construction down big, over 7% apiece. Then you look at the risk off category of yield sensitive. The XLP Staples down, XLU Utilities down, IYR down, real estate, XLV Healthcare down too. Then you look at the dollar was higher. So anything that is dollar sensitive went down. So you look at emerging markets, international markets are down. Crypto ETFs all down. What else is dollar sensitive? How about metals? XLB, XME, all down big for the week. And thank you, of course, to the GDX gold miners, down over 3.5%. Thank you to new amount earnings, by the way. But then you look at the GLD, actual gold, that was positive for the week. And this is why we said, as an investor, you want to be in GLD, not GDX. As a trader, you can play with the GDX. You can use it as a hedging mechanism against GLD. But as an investor, you want to be along GLD. Now, US oil was positive for the week, but that's going to be a different story this week as we price out some of the geopolitical speculation. We'll talk about oil in a minute, but you have nat gas, huge gains. UNG up over 10%. Boyle, that's the one that a lot of you love to trade, above 7.5% gains in the week. I think there was a squeeze situation happening in nat gas. What about commodities? Crude was higher for the day, up about 2%. Along with gasoline, RBOB, and heating oil and nat gas. Of course, nat gas is a separate thing altogether because I think what's going on in nat gas right now is a mechanical squeeze. But with the Israeli response coming out tame, we see oil overnight down about 4%. Now, folks can look at this as, oh, this is a negative for oil. I actually see it as a positive. You know why? Because when we look at the tailwinds for oil, you have the geopolitics, you have China, you have, most importantly, the Federal Reserve rate cuts. That's the strongest catalyst for oil to go higher. But recently, since everybody was anticipating the Israeli response, we've seen a lot of speculators hopping in and bidding oil higher. Those are the weak hands. You get a tame response, they'll get out right away, and you'll see oil going down in a bigger percentage point as we see overnight, 4% plus. But once they're out, the geopolitical situation is not resolved yet. And the most important catalyst, which is the Federal Reserve rate cuts, still intact. So once you wash the speculators out, the weak hands, I think oil begins to gather and get more stronger hands bidding it higher again. Now, if we look at softs on Friday, positive for the most part. You know that my favorite is OJ, which was up about 2%. Then you have coffee up about 1%. Cocoa positive along with lumber. These two I don't trade for now. And then cotton waiting for a positive entry here. But it was down on Friday, about a little over 1%. But we're watching cotton. Maybe it's going to offer an entry really soon. What about metals? Gold is positive despite the fact that the dollar was higher on Friday. But boy, look at palladium. Up over 3.25% on Friday, up big for the week. We suggested last weekend's video to buy PALL. This is the Palladium Physical ETF. This is the one that I added to my portfolio. Next thing you know, Palladium is exploding higher. If you look at grains down across the board with the dollar going higher, really sensitive to the dollar. So we see wheat going down about 2%. Soybean, corn all down for the session. Looking at the week all in all, nat gas is the number one performer, up over 11% for the week. But look at palladium, up also close to nat gas, up about 11% for the week. Now, if the dollar goes down, it'll be even a better catalyst and a more of a positive tailwind for palladium to continue to go higher. It was a positive week for energy, but we'll see a negative reaction Friday. The underperformers, cocoa down about 9%, then coffee down about 4% for the week. But again, coffee still has stronger tailwinds. We're going to look at the charts this week and identify if we see an entry, a long entry for coffee. OJ is the one that I like in softs right now. Moving on to the big casino options, what do we see here? The volume was concentrated in Tesla and NVDA on Friday. The rest of the market is dead, with the exception of MicroStrategy, which we've seen an increase in volume. It's becoming a favorite table for speculators, along with Palantir, of course. So the entirety of the market is now becoming a gambling casino based on these options. We see the bias still for calls versus puts. Nothing stands out in the IV rank, so when it comes to Tesla, yes, it is a mechanical squeeze, but we're not seeing an IV rank of 100, for example, where we say, okay, the risk is now for a pullback or flushing down some of these gains in Tesla after earnings. You're still at 55, 56. So we'll look at the chart in a minute. When you get to 80, 90, 100, that's when it becomes more dangerous and harder to keep the direction that the stock been heading to as the implied volatility heads higher. The only one we see is DJT, that's the Trump media. The IV rank is about 85, and the stock been rocketing higher. We all know why. The expectations are that Trump is going to win. But if we hit to 90, 95, I think the polls are going to tighten as we hit to the final week. And you might see a pullback for DJT. Now, if the stock trades higher all the way till the elections, before the elections, I should say, and the IV rank is at 90 or 100, then I'm going to buy puts on it because even if Trump wins, you'll see sell the news kind of reaction. So that's going to be a trade on a silver platter that you got to take. Now, if we look at the flows on Friday's session, the bullish flows, IWM, CPRI, Capri, Qs, Pinduoduo, Apple, Humana, Google, Eli Lilly. The bearish flows, Netflix, Microsoft, Google, Vikings, VKTX, NVDA. That's really interesting. That's the bullish ETF for NVIDIA. ZB, bonds. They're betting that yields are going to go higher. Then we have LRN. This is for Stride. The stack was up over 40% for the week, and now they're beginning to fade that rip. Let's talk about the unusual activities that we got for Friday because we have a lot of them, and some of them really interesting. I want to show you before I begin this kind of manipulation that happens every single day in the market, where you have some firm, as you see right here, buying the 200 synthetic future for Apple for March 2025 with millions and millions and millions of dollars and billions of dollars worth of notional value. And the algorithms take this signal to buy the stack higher. And we see this phenomenon day after day after day, where early on in the morning we see huge bids and huge orders from a single firm or a collection of firms buying the same contract, deep in the money calls, and pushing certain stacks higher. Then they exit, they book the profits, and they painted the tape. Is the SEC awake at all? Of course not. They're in a coma. But again, this kind of manipulation, we're going to look back to it. It's going to backfire and amplify the downside in the market because instead of piling in the calls, they're piling in the puts. And as they pile in the calls before we see reversals in the market, they have to reverse and unwind all of these bets. And that's going to exacerbate the move to the downside. Keep that in mind. It's going to come handy near the future. But if we look at the unusual activities, forget about the pumping in Apple using the algorithmic trading. We have an actual unusual trade here of buying the 232.5 calls, the expiration date November 1st, spending about $1.5 million. Now, this is a pure earnings play. They're betting that Apple will produce a positive result and head higher above 232.5. Now, since they paid about $4, the break even would be at about 236.5, 237. So they're betting that the stack will be at about 240 by the end of the week. Then we have a long synthetic future for the Qs. And you do that by selling the 460 puts, buying the 460 calls, the expiration date November 22nd, 2024, spending about $41 million. What it says is high degree of confidence that the big cap earnings will be positive and we will see a breakout in the Qs leading us way above 460 where the trader is comfortable enough to sell the 460 and raise cash from it. Then we have a positive one for NVIDIA, buying the 168 calls way out of the money now. And the expiration date is Jan 17, 2025, spending about $5.5 million. So if you add all of these three trades that we just talked about, Apple, Qs, and NVIDIA, they're betting for a positive outcome from earnings. And if we do have a positive outcome from earnings, you will see a chase at the end of the year. And that's what they're betting on right now. And speaking of chase, here's Tesla. Somebody bought the 330 calls, the expiration date December 2024, spending a little over $1.5 million. We'll look at the charts in a minute. I think once the IV rank begins to increase and we hit some technical resistance, the stock will pull back. It's going to be a bigger pullback because you have to unwind a lot of this mechanical phenomenon that took place this week. But timing is of the essence. You don't want to time it wrong and then it keeps squeezing you higher. Then we have WFC Wells Fargo calls. Somebody bought the 70 calls December 20, 2024, spending about $2 million. What they're betting on is, of course, perhaps yields going down, alleviating some of the risk that we have in Wells Fargo from the commercial real estate portfolio. And here it is, DJT. They're betting for more gains to come. Bought the 33 calls, sold the 37 calls. The expiration date November 1st, 2024, spending about $1.2 million. If we don't see polls showing that Trump slipped down, I think you could see DJT continuing to go higher. As it becomes pretty much in the bag that Kamala is going to lose, Trump is going to be the next president. But as I said, if we head before the elections and the stock is way overbought and the IV rank is at 100, I think it becomes a silver platter trade to short it because if he loses, the stock will crash in a big way. If he wins, we'll see perhaps sell the news phenomenon. As okay, this is behind us now. The company is shit. It doesn't produce any revenue or any profits, so you dump it. We played it for the elections. Thank you so much. Now we're going to look for another trade. Let's look at the unusual bearish activities that we got on Friday. UPS, even though the report was a positive surprise, but it seems that the investors are not buying it. Right off the gate, the response from a gap higher on UPS was holders of the stock dumping it at a better price. And now we have somebody betting for more losses to come in UPS. They bought the 135 puts, the expiration date March 21st, 2025, spending about $1.4 million. So this is a case where we see the report, but then maybe the investors, the holders, are not convinced. They think maybe we've seen a surge in activities based on rate cut optimism, and that's going to fade away. And that's why they're looking at it as an opportunity to book some value out of the stock, be it profits or loss, and get the hell out. Then we have a put for Meta. So again, they played positive earnings bets on Apple, right? But they're playing a negative one for Meta. They bought the 570 puts, the expiration date, November 1st, 2024. So we know it's an earnings play, spending about $1 million. What is the case for Meta to go down? Again, margins begin to peak and trim down because Zucchini is now spending like a drunken sailor again. And the revenue expansion, they did not do any elections advertising. So the revenue will be static, but the cost will go higher. Margins are going to get squeezed. And we see investors saying, okay, we've peaked in Meta. Let's dump it, find another opportunity. Then we have the IWM long puts, the 209, 208 puts bought for November 15th, 2024. Spending about $1 million. Somebody's bearish on the rotation here. And the last bearish trade, it's actually a bullish one for the VIX, but bearish for the market. Somebody bought the 30 calls with the expiration date December 18, 2024, spending about $3 million. A lot of you want to go along the VIX before the elections because it seems like a silver platter kind of trade. I suggest you do something like this because if you buy the weekly expiration for the VIX, you might just waste your money. Overpay for the options since everybody's buying them. And then if you don't see a big pop in volatility, you lose money. But if you have the December 18th puts, or calls in this case, they're going to hold value because folks are going to look into earnings and the elections and a lot of other catalysts. So you see the VIX, in this case, the December options holding better value than the weekly and the monthly expiration. Let's move on and do some charts and then wrap it up, folks. We begin with SPY, the S&P 500. Here's the hourly chart for you. Any update from Friday's session? Obviously, gap and crap. But did we see any significant damage, such as losing the support of 578.54? No. You know your confirmation to short the SPYs if we lose 574.5. So just because we got a gap and crap, okay, that's a bad sign. But it's not conclusive yet. Because all in all, you still got rejection from 583.23, but no confirmation of losing 574.5. And right now, you have another bearish signal, but no confirmation yet. This signal is losing a mini trend line. So there is a bearish case to be said here, but from a technical perspective, it's not confirmed yet. We did not lose 578.54. We did not lose the most important line, 574.5. Now, of course, again, I'm just presenting the arguments for you. The bullish case would say we haven't lost any support yet. So gap and crap, who gives a shit? But then if we clean up the chart, go look at the line chart. Doesn't it look like a triple top here? And you have big cap earnings. Put two and two together. Any disappointment? Then the triple top will be confirmed. And we see the SPY heading down. Now, if we look at the daily chart for the SPY, we're still above the 20 days moving average. So another bearish confirmation will be losing and closing below the 20 days moving average. The last 3 times we've done that, we got a bigger flush down. So for now, you got to write these down. On the daily, the 20 days moving average. On the hourly chart, you got 578.54. But the most important line, 574.5. The other thing in the daily chart, clean it up here, we still have the phenomenon of a rising wedge. If we break it down, it's probably going to produce a flush. Now, we have big cap earnings coming out this week. Put 2 and 2 together. If the rising wedge is going to produce a big flush, it's going to happen because of disappointment from earnings. You look at the weekly chart to see the wedge a little better. We're still within the wedge. But boy, it's looking that it could go the other way. And we get a big flush down, and that's going to be the confirmation that we're done. It's over. We're heading down. And you'll see it in the MACD, you'll see it in the RSI, you'll see it in the Vortex. But right now, it's not showing up yet. Keyword, yet. What about the Q's hourly chart? If you want to throw cold water on the negative reaction by the SPY, closing negative at the end of the day after trading positive, you can use the Q's as your evidence. Yes, we've seen a gap and crap here too, but we haven't closed negative for the session. Means that technology at least stronger heading into the earnings reports. And Monday maybe could be a positive day for a move higher in the Qs again. The important lines that you have to look at. 493, that's number one. That it could be a confirmation that, okay, we traded back to the highs and we're not going to make it, and down we go. But the ultimate confirmation will be 487. You lose that. Oh, we're heading down for sure. So if we look at the daily chart, here's the topping candle, quote unquote. We hit the upper Bollinger Bands and came down. So no biggie for now. Confirmation, you lose the 20 days moving average. At least that's in the daily. 487 is my number, most important one on the hourly, and I think it is more significant than the 20 days moving average. Another way to look at it is, once again, a rising wedge pattern in the Qs and stopping exactly at the top of the wedge. Now we look at it from the weekly chart. Oh boy. Again, those big cap stocks, they better deliver. Because if they don't, it's going to be one of the strongest top and reversal signals that we have ever seen. Keep an eye here. If it breaks down, it's going to break down big. It's going to be because a disappointment in the big caps. And if we go down in the flush, we do have a major trend line that we can go back and retrace all the way since March of 2023, the banking crisis and the Fed rescue thereafter. So if we break down here, we might revisit that line, which would be about 10% from this point on. And again, no biggie, but if you go over 10%, then what more evidence do you need that it's over? It's done. The IWM small caps. Good news, above the 50 days moving average in blue. Bad news, we lost 222 and we stopped short of 222. And we've seen a reversal candle on Friday. Your confirmation that you're going to go with short bets on the IWM. You lose the 50 days moving average, you're probably going to go down all the way to the trend line. If we look at the dollar, we got a bearish engulfing candle, which we're now debating. Friday, of course, this is a big test. If the dollar goes down Monday, then there was a geopolitical element in the rise in the dollar because we have no macro data on Monday. So watch the dollar. If it goes down on Monday, that means that we're pricing out some of the geopolitical hedging from the dollar. And that's going to bode pretty good for your boy, the old man, gold. You look at gold futures, looking pretty good here. We got a bearish engulfing candle, though. That was on Wednesday. You got to beat that, trade above it, close above it, to have the security that higher we go in gold and the dollar going down, you know the deal. But I think right now gold is becoming more sensitive to the dollar, meaning if the dollar continues to go higher, the likelihood is that gold is going to go down and retrace the trend line that you see in this chart right here. That's the weekly trend line, by the way. You look at the gold miners GDX daily chart. We talked about this phenomenon in the beginning of the week, that we could see gold, the commodity, and GLD, the ETF that tracks the commodity, going higher, but the GDX, the miners, going down. Why? Because of earnings. Well, we got it spot on because new amount came out disappointing. That's what the market says. The name was down over 15%, a big weight in the GDX. So if you utilized my hedging strategy, which is if you long GLD or gold futures or physical gold, and you bought some GDX puts this week, you did not lose in your main position, gold, but you gained from the hedge as the GDX headed down. And this is why I do like hedging via proxy in my gold position, utilizing either gold miners or this guy right here, which is silver. And again, silver looks like maybe it's going to head down. If the dollar goes higher again on Monday, probably going to head down. And that doesn't mean that gold is going to head down. Gold needs big pops in the dollar to head down. So if you see this phenomenon of gold holding, dollar going up, using the SLV to hedge against your gold position will be a good idea because it's also going to head down. It's more sensitive to the dollar than gold right now. If you look at crude oil, we traded at the 20 days moving average, consolidating back and forth, back and forth. The momentum looks positive, but we know what's going to happen on the open Monday. We're down about 4% or so. My 2 cents. You wash out the weak hands, stronger hands going to come in, and we'll see buying of the dip in oil. What do you do with the XLE, though, if you have energy stocks? The bad news, bear flag, played out a little bit, and the commodity is going to be down Monday. Good news, we're above the 50 days moving average, and what's going to dictate the action in the XLE and energy stocks will be earnings from Exxon and Chevron comes Friday. So if you look at the weekly chart, the 50 weeks moving average is actually the most important indicator, because if we close below, we have more downside to come. If we bounce from the 50 days moving average, it's going to be a strong buy signal for energy stocks. And I think it will happen because of a good report from Exxon and Chevron. That's the only reason that I think that could lead XLE higher, breaking above the trend line and maintaining the 50 weeks moving average as support. What about the 30-year bond yield? We're looking at the daily chart right now. We've identified sort of a falling wedge. It did produce a mini pullback, but it did bounce back from the support that we have identified in the beginning of the week, 4.44%. What happens now? I think Monday we have no macro data, and it's really important to watch the behavior of bond yields because bond yields going higher, there is nothing geopolitical in that. If bond yields were going down, sure, it's because folks are buying bonds because they're afraid about the geopolitics. So if you want to throw cold water when a pullback in the dollar, because, it's going to price out some geopolitics. Your evidence is right here that yields been going higher along with the dollar. So the dollar is going higher for another reason, not a geopolitical reason. But like I said, the most important catalyst for bond yields and the dollar this week would be the PCE. Not a big deal, really, in my opinion, unless we see a big upside surprise. But the most important report will be the employment data coming out Friday. Now, we know in the weekly chart that the 30-year bond yield still has positive momentum. It's above the 20 weeks moving average. It's about to hit the upper weekly Bollinger Bands. So it can continue, theoretically, can continue to go higher Monday, Tuesday, Wednesday, Thursday even in the daily chart and become really, really absurd in the technical indicators in the daily chart. And you see it already hitting the upper weekly Bollinger Bands. If that is the case, comes Friday with the jobs report coming out, it would make sense to bet for yields going down, TLT bonds going higher, because the report will be worse than people anticipate. But for now, yields going higher, specifically in the 30, not good for the XHB. So that bull flag that we talked about last week was gone immediately Monday. We flushed down all the way to 117.17. And that support is broken now. So can we see more downside in the XHB if we assume that yields go higher Monday, Tuesday, Wednesday, Thursday, even all the way to the employment data? Yes, we can. But the daily chart will offer some support because we're already at the lower Bollinger Bands. So if you're going to open a trade, it has to be a little bit longer dated because you're going to be betting on the weekly chart instead. If you look at that, you got a bearish engulfing candle, you got the momentum indicators rolling down in the MACD and rolling down in the RSI, and they're rolling up in the Vortex indicator in favor of the bearish momentum. So you have a case here to bet against the XHB, and it's probably going to be a spread of, let's say, 115, 100, 115, 105. You can be a little crazy and you go 190, but that's going to be more speculative. If you want a better trade, you're probably going to go with the 115, 105, or 110, 100 put spread, but you're probably going to go December, if not Jan 2025. If we look at the IYR real estate weekly chart, look, if yields go higher, then I'm going to reiterate here that we're going to do an inverse ABC pattern in the weekly chart in the IYR. The only scenario where we see the IYR moving back up is if yields go down for the wrong reasons, meaning a recession reason. The only catalyst I see this week is the employment data on Friday. The KRE regional banks risk-on yield sensitive this time around. We said once you have a breakdown candle, you have the 3 days rule. Either you reverse the breakdown candle or you're more likely to find sellers, and we see a bear flag playing out. It appears right now that this is the case. Since Friday was a weaker reaction and we got a bearish engulfing candle again. And the momentum indicators, the MACD, the RSI, all rolling down. So it would make sense to bet against the KRE. If you wake up Monday morning, you see bond yields going higher again, it'll make sense to bet against the XHB and the KRE. In the case of the KRE, you can be shorter dated because you have all the way to the 50 days moving average in blue, maybe a little below. But then in the XHB, you want to go a little longer because here's the thing with the XHB. Even if bond yields go down Friday, if they go down for the wrong reasons, that's going to be bad for the home builders, and they continue to go down. What about the Chinese names? Alibaba continued to go down this week, and it's still a touch below my line in the sand, 98.40. So right now, my strategy is hedging, and we've been hedging all week, using either the ticker Yang, being long Yang, that's the inverse for China, or having the puts on the FXI. Those are the cheapest options. And we'll keep that strategy for another week. If we see BABA trading above 100 again, and most importantly, closing above 103 by the end of the week, okay, we got a recovery, the bottom is in, higher we go. And perhaps a leading indicator, that could be the case. You got to remember, you need that dollar to go down though, because the dollar is going to keep emerging markets weaker. But perhaps a leading indicator that BABA is about to reverse higher again. Look at the 4 hours MACD. Played out the bearish momentum, that's now topping. And we're about to see the reversal in the bullish momentum. And if it results in a weekly close above 103, then we're good to go. The VIX 4 hours chart, we got the bearish confirmation with a close above 20. But now the debate would be, was it a false close? Was it based on the leak that the Israeli attack will be Friday? And now that we know that the attack is lame and tame, at least for now, can we see unwinding of some of these bets and the VIX trading below 20 this morning? And we see the equities futures going higher and closing higher at the end of the day because the VIX closing below 20. That's a possibility. But like I said, you look at the monthly chart of the VIX, the weekly chart, the daily, there is a threat. Now, I think if the big caps disappoint this week, you might see a pullback Monday in the VIX, but then it pops above 20 and way above 20 by the end of the week. Looking at the big Kahuna apple, what do we see here? We got an inverse ABC as we discussed all the way to the trend line, and now it's kind of holding below 233 and holding the trend line of support. So on the hourly, there's nothing for us to do. This is going to be an earnings play. So we have to look at the weekly chart. And right now, we got what appears to be a positive break outside of the wedge consolidation pattern. But we all know that the MACD indicator, the RSI, the Vortex, all pointing out that the bullish momentum has stopped. It's getting weaker and weaker by the day. It's probably going to reverse to bearish. I only see one catalyst for that happening, which is a disappointment by Apple when they report this week. So my 2 cents, just looking at the charts, and again, earnings are not a technical catalyst, not a technical event. They're influenced by the technicals in the aftermath. It's a fundamental / a mechanical catalyst. So you take the technicals with a grain of salt, but if I had to bet, based on the technicals alone, looking at this weekly chart and the momentum indicators, I'm probably going to bet to the downside. And the souffle Tesla, the top performer of the day, of the week, why did that happen? Look at the daily chart. We got consolidation just above the 100 days moving average. And pretty much everybody and their mothers, me included, we bought puts with the intention of, look, we might head down before the report comes out. So maybe there's a pre-earnings trade here. You get in and out really quickly and then see what happens with earnings. And you can go back to my Discord replies to all of you who said I have the Tesla puts for earnings. I said, look, if we go down to 215 or below, before the report is out, you book your profits for the most part because you never know what's going to happen with earnings. And then you leave a little bit on the table, 25%, 20%, 10%, just in case we see Tesla flushing down. What I did is closing the bearish trade all together for a profit because I played it right all the way till the earnings. But then before the earnings come out, you close the trade. And we've done a lotto instead. And we only spent $1 on it. It was the only lotto that did not work out from a directional that we've done this week. But here's the response. If you go back to the chart, the response is a huge squeeze higher. Why? Because everybody assumed that we have a bearish pattern, and we've broken below the 100 days moving average, and we have problems with the margins from previous reports. So it was an easy bet against Tesla. They come out with a positive earnings report, at least for now, showing an improvement in margins. That, hey, your assumption pre-earnings were wrong. What happens after? A mechanical squeeze. Everybody who got in short, now they have to cover. And when they cover, they buy call options to compensate for the loss. And that leads to a gamma squeeze. And this is why we've seen Tesla blasting significantly higher. But now it's going to reach the upper daily Bollinger Bands. It's going to have a hard time to continue to squeeze higher. So maybe this week we'll have a pullback trade on it. We got one on Friday, by the way, and it worked out in the morning. It was a quickie. Can we have a more significant one this week? I think so. But bear in mind, look at the weekly chart for TSLA. It closed above the 200 weeks moving average. That is significant. You're not going to bet against Tesla for a longer expiration date or short the name until you lose the 200 weeks moving average again. Because the risk is that the daily could offer a pullback for a mechanical reason. But you look at the weekly and it looks right now as a cup and handle pattern, which means in the medium run, let's say 2 to 3 months from now until the next report, we could see more folks joining in and buying Tesla and leading it higher, perhaps to the 300 level if not above, until we get something that says, nope, the improvement in margin was a 1 quarter thing and now we have to face it again. We'll talk about that in details when we do the Tesla analysis. That's going to be a separate video once again, because this video is already too long. We talked about a lot of things that cannot squeeze it in. Another important level you need to look at, 271. Closing above 271 for the week will pretty much guarantee more gains to come for the souffle. We'll look at NVDA hourly chart. This one was frustrating because, yes, we had a wedge that broke down, but we've never really closed below the trend line in yellow, as you can see. If we do, and we lose that trend line, NVIDIA will probably go down to close the gap at about 136. But then you look at the daily chart. Here's the trend line once again, still intact. Maybe reversal candle on the daily chart on Friday. But we didn't lose anything significant. What we know is right now the risk is to the downside because the stock is up about 20% for October, pricing in a really rosy story. If Microsoft negates the story, we're not talking about ASML anymore. We're talking about a giant with huge ripple effects on the entire AI sphere. Then NVIDIA will break the trend line and begin to flush down because you see the momentum indicators on the daily, the MACD, beginning to roll down. So the best of the gains are behind us. Now the possibility of downside carry the better odds. And lastly, tulips, Bitcoin, daily chart. Got a break above the trend line. We're debating it right now. It looks bullish. It looks positive. But again, it cannot rally with the dollar rallying too. You need to see that dollar pulling back before you see a breakout in Bitcoin. And again, I've been saying since last week that I think that the dollar is overreacting here and introduce any recession fear. You will see the dollar flushing down. And if that happens this week, you'll see all of that class of assets that I talked about in the intro of the video, gold, commodities, all going higher, with the dollar going down, but also Bitcoin, because it is dollar sensitive. Is there risk that Bitcoin could give up the bullish break here? Yes, it could. If the dollar continues to go higher relentlessly, then there's something huge going on in the market in terms of fear. And at that point, we will see risk-on assets like Bitcoin flushing down and reversing the bullish signal that we got last week. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, we got nothing. Could be a good day for the market to rebound and close positive. Why? Because we're taking the geopolitics out of the way now. Oil going down, perhaps the VIX going down. No macro events that could spoil the party. You probably might see the dollar bond yields, even if they tick higher. They might not bother the market that much. And after the response by Tesla, you'll see a lot of shorts in the big caps also considering their positions. That, hey, maybe I should wait. Maybe you should reduce the short position a little bit. So Monday has all the possibilities that it could be a positive day for the market. But then Tuesday, the 29th, we begin to get a lot of corporate earnings. We'll talk about that in a minute, but we also have macro events, such as the Case-Shiller Home Price Index. We have consumer confidence and job openings, all important pieces of data. Wednesday, the 30th, we begin to get more serious data like the ADP employment report for the private sector of the economy. We get an update for the GDP, for the trade balance, and pending home sales. Then on Thursday, it gets even more serious. Now we have the PCE report, the Fed's favorite. We have the employment cost index, really important for the economy, really important for the dollar and bond yields. Then we have the Chicago PMI. We conclude Friday with the most important day macro-wise. We have the employment data coming out right off the gate. But on top of that, we have manufacturing PMI, ISM manufacturing, construction spending, all important data for the economy. What about the earnings calendar once again? The most important week of the year so far. We begin Tuesday. Before the bell, we have Pfizer, Mondelez, PayPal, and McDonald's. After the bell, we have Google, aka Alphabet, AMD, Chipotle, and Visa. Wednesday, in the morning, we have Eli Lilly, AbbVie, and Caterpillar. After the bell, we have Microsoft, Meta, and Amgen. Thursday, in the morning, we have MasterCard, Merck, which went down big recently, so everybody will be watching this name. Is it going to offer a rebound opportunity, a buying opportunity? We'll see. We got Uber, Bristol-Myers, and Regeneron. And after the bell, two giants, Apple and Amazon, along with, used to be a giant, not anymore, Intel. And Friday, it's all about big oil, Chevron and Exxon. Now, folks, in tomorrow's video, we're going to do in-depth analysis in previewing the earnings for these big cap names. What are we actually looking for in each of these names? So it's going to be an interesting and fascinating conversation tomorrow. And since we're concentrating on earnings week, we're not going to do a macro coverage this week. We'll do it next week as we wrap up the employment data. So folks, this is all I got for you for now. I hope you enjoyed the video and you found it informative. If you did, please return the favor by pressing the like button, subscribing to the channel, leaving us a nice comment in the section, and consider joining us as a member so you can access the videos that we do during the week and other bonus videos, plus the Discord benefits, whatever you like. But with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. Appreciate and love all of you. I'll be talking to you again tomorrow. Good night.